If you're an innovator right now, are you missing out on the biggest transformation in technology since the Industrial Revolution? Or is AI just a bubble that's going to pop soon and leave you holding the bag? In this video, I want to show you how bubbles are bullshit, and that we're going to look at real data and real timelines to help you understand how to really plan your investment in time and treasure to make sure you succeed no matter what happens. So let's get into it right now. All right, first thing we need to get at is when most people think about a bubble, they think about this guy. This is Michael Burry, and played by same guy who played Batman, which is pretty cool. If you're going to get played by anybody, to be played by Christian Bale, played by Batman, that has to be the coolest thing ever. That probably does some things to your ego, but neither here nor there. Michael Burry has been out of the news lately for talking about the AI bubble, and specifically capital expenditures, that essentially the technology infrastructure investments in the chipsets and the hardware don't match the payback periods. He's got a great track record from the financial crisis of 2005, 6, 7, and 8, where he called it correctly at that time. The issue with a lot of people like that is not necessarily that he's wrong. It's that sometimes we can predict, what's the old story? We predict 14 out of the past 9 recessions. So the issue here is not that he is going to be right or he's going to be wrong, but he could be right and his timing could be very off, or circumstances could change. Not a really good way to think about how you're going to invest your scarce product development dollars into a trend that may last much longer or much shorter than you think. The next way people think about this is something called the Gartner Hype Cycle. If you're not familiar with this, it sounds really intuitive that there's a technology trigger. It rises to a peak of inflated expectations. That is the hype bubble. It crashes quickly into a trough of disillusionment where people are kind of down on the technology, whatever it is. And then you get a slope of enlightenment where that starts to pick up steam again and people are thinking about it. And then eventually you get to the point where the technology starts to generate the kind of returns that we have expected all along. Again, that takes time, and what the graph is trying to intuitively show you is that there are different sequences along that path that will make sense, and you want to make sure you're not caught in the wrong one, or that your strategy will differ based on which one you're in. The problem with this is it is an example of sequential time and perceptual time that is not bounded by chronological time. When you are going to make an investment, you absolutely must fix chronological time. You have to actually have data. You have got to see what the timeline looks like, because there is no correlation between how long each of these stages in the sequence needs to last. I'm going to say that again for people in the back. This is not chronological time. This is a perceptual time. It's more marketing than it is actual data. We need to start looking at actual data. As many of you know, I am a historian of innovation and of marketing and these types of cycles. And this sort of Gartner hype cycle drives me bat crazy. I understand that the historical examples very rarely match these kind of simplified models we give you. And I'm going to prove it to you. A company called the Mann Group put together these charts of historical bubbles, things like the Dutch Tulips, the Mississippi Colony, Polish equities, all kinds of different ones. They tracked and categorized the data on a number of different bubbles. When did they start? What was the kickoff? When did they peak? When did they end? Now, those dates are a little bit subjective, of course. Where do you pick those? The point, though, is that they are actually measuring fixed chronological time on the same scale. The number of days from the start, from 1 to 1,000, 1 to 4,000, 1 to 5,000 that we'll see. They are also fixing the y-axis, the up and down axis, based on a multiple of the starting price. That way we can compare Dutch tulips to Bitcoin in a way we couldn't really do before. Okay, so let's take a look at this first chart. This compares 4 bubbles over the course of 1,000 days. That light blue one is Dutch Tulips right here. We can see that in the beginning. Bitcoin is the green one, a little bit harder to see. Now, they are ending this one. They did this analysis in 2018, so Bitcoin is not quite finished yet. We still have Bitcoin today in 2026 as I record this. I'll actually do some of that longer term trend work with AI. But for now, just know that Bitcoin has wobbled along since then. It doesn't look like the Dutch tulips at all. Mississippi colony, very similar, and Polish equities. What do you notice when you look at all of these charts kind of on the same place? A few things. The first thing that you should notice is effing nothing. That they all look different. When you actually look at the data, they don't look anything like the Gartner Hype Cycle. That should be brilliantly obvious to you just by looking at this chart. It's funny what actual data looks like compared to the marketing BS we tend to find out there for the advice you are trying to use to work on your investment, your product, your blood, sweat, and tears, your corporate resources. If you're an inventor, the nights and weekends in your garage you're spending, don't pay attention to that. Off my soapbox for just a second. Okay, some actual things that you might notice. Look at how long these are taking. We think about bubbles as inflating and popping quickly. And in Dutch Tulip certainly did. It didn't really take that long. Longer than people thought. I mean, this spike right here is many months long, although it kind of went up quickly, went down quickly again. But take a look at these other ones. Look at Bitcoin and look at the run up on Bitcoin and how long it's taken. Look at the Mississippi colony. Look at Polish equities where it went up and yeah, it crashed, but then it wobbled along and it's still higher than it was at the beginning. Let's take a look at some other data, a little bit of a longer time cycle. This has got a lot of information on it. And I like what they did here. And what I think they did that's best, and you can tease apart each one of these pieces of data. RE stands for real estate. So this orange one is the real estate market in the United States. You just sort of look at where that is. You can look at the Dow Jones Industrial Average, this first one, this spiky one right here. This is 1921 to 1932, kind of my area of research and study. So I know this one really, really well. But US financials, Japanese real estate, all kinds of different charts. What do you notice taking a look at this? Absolutely nothing. And it's what you should notice is absolutely nothing. Take a look at the Japanese real estate market, for instance, where just going up and down over the course of 4,000 days. Okay, well, 4,000 days, what is that? Multiple years of work. This is literally years and years and years. So when we think about a bubble inflating quickly, popping quickly, I can tell you that these things go a lot longer than you think. And just looking at the data will tell you that. And not all of them crash, kind of using air quotes. Oil in this case wandered along a long time before it kind of hopped back down from 1973 to 1986. That's 13 years of bubble. Is that really a bubble when something is inflated to a high level over 13 years? You got to think about that and don't use messy language. Let's look at one more chart from the Mann Group, and I really want to highlight this one because this one is the one that jumps right out at me as look at the different spikes. Many of these spikes, Saudi equities, Japan real estate, that one's plotted here as well. I like this one. But here's gold from 2002 to 2015, the gold line, as you might guess. 5,000 days, multiple years, that's 13 years of a slow climb, a little bit of a peak, and a bit of a decline over that time. Is that even a bubble? Are we in a bubble now with AI? Let's start to actually look at the real data now that we've seen that past bubbles are bullshit. And past bubbles really aren't bubbles, and they really don't make a lot of sense from a what should you do as an investor of new product development scarce resources. Let's take a look at AI right now and see what we learn and see what you should do as a product developer right now to either take advantage or sit on the sidelines. What I like here, this one comes from Aventus Advisors. I had to look at that to make sure that I got them right and gave them credit for compiling this data. The first chart I want you to take a look at is AI valuations. This is the number of funding rounds by stage. What this is showing is funding rounds. That means anyone raising one round of funding, pre-seed all the way through Series B and other rounds like mezzanine funding and things like that. It gives you an idea of just the investment activity. It's a one-off metric. So if someone raises $1 million, if someone raises $1 billion, that counts as one. We'll get into the quantitative side, correcting for that later. This chart is giving you a sense of where investment activity and energy is going. But take a look at down here where we're saying we're all excited about being in a bubble. Well, gosh, the investment activity, the number of rounds, there are a lot of investors in here. Gotten a little bit of a spike in 2025. 2026 Q1, again, we'll probably see a higher number in the next year. But think about the pandemic years, 2019, 2020, 2021. Were you really hearing a lot about AI at that time? Yet, take a look at the investment activity during that time. Was everyone kind of investing in a bubble you just didn't hear about? Not really. This is important to understand when you take a look at the hard data here from 2010 to 2025. This is 15 years of what looks to me like pretty consistent growth. Let's take a look at some other ways to look at this data. Let's take a look here at the value of capital raised. So this corrects for the $1 versus $1,000 counting as one. This is actually taking a look at the amount of money raised. You can see here that in the early days, first 5 years or so, this is $7 billion raised. $1 billion here, $1 billion there. Pretty soon you're talking about real money, right? Well, think about this in comparison to the $289 billion raised just in Q1 2026. This is where people are starting to talk about bubble, and they're starting to really take a look at these skyrocketing amounts of money out in the public domain and thinking about, ooh, boy, is this really something that we should be careful of? What I want to call your attention right here, and they've done a good job of marketing it, is this is ChatGPT. Right around 2023, you start to see AI enter the public consciousness. And a couple years later, a corresponding spike in the amount of investment. That shouldn't surprise anyone. When more people get into this and more people understand it, more of your average investor, not the more professional investors who see this coming a long way off, but the folks who are angel investing, the folks who are really plowing money into these companies as they begin to scale, that is a natural sort of thing. This thing happened the same way with the railroad stocks in the 1800s. A lot of small scale investment, but then when you needed to do transcontinental railroads, you needed a lot more capital to be able to do that. You just simply cannot do that on ones and twos. You need hundreds and 200s. It's a different game at that point. Once the technology shows that it is viable, that's when the money starts to flow in. That does not necessarily mean there's a bubble. It doesn't mean there's not either, but it doesn't mean there is. And finally, let's take a look at kind of the past 5 years for who has gotten the money. This one's interesting here that we're taking a look at OpenAI, the big investments there, and Anthropic. Now, take a look at those companies, the companies you hear about all the time. You hear about OpenAI, ChatGPT, Anthropic with Claude. You might hear a little bit about other AI tools here and there, but really, of all of the investment, yes, OpenAI and Anthropic are soaking up a certain amount of that investment, but take a look quantitatively over the years. Have they really dominated the AI infrastructure investment rounds? Not really. So what do you need to do? What takeaways can you understand as someone who is thinking about your own product development? Number one, and some of these come from the Mann Group. Some of these I'm going to add in and put in product development language. Number one, bubbles are longer than you think. So when people start to talk about bubble, and people talk about bubbles in 2004, 2005, 2006, I was there in the real estate market at that time. When did the bubble pop? 2007, 2008. Make sure that what you're doing from a product development perspective has a longer term outcome than whatever is going on in the media at this time. Number two, when the bubbles come, they usually go down faster than they go up. But think about the data that we looked at. Sometimes that's true. Sometimes it's really not. And sometimes there's a peak and then a slow decline as people are rethinking their investment strategies and rethinking where they're putting their capital. Is AI going to look more like Dutch tulips, or is it going to look more like railroads where they went up and spiked and then slowly tapered off for a long period of time? That would be my guess, is we're going to see that. If you do, though, invest at the peak, and this is more for investors, you invest at the peak and you're going to be the one that's going to lose the most. So it's better to get in early. If you have not gotten in at this point with some of these investments, it is unlikely that now is the right time to do it. When you're thinking about your AI technology, you've got something that's going to kind of go right on to that AI hype cycle that's happening right now. You have probably missed that boat. You want to make sure that whatever product development you're doing is aligned to customer needs that are going to persist well beyond whatever the hype cycle really looks like. Number four, and this is where I think the Mann Group really kind of hits it right on the money. I'm going to read this exactly as I see it. There is a little discernible pattern that allows accurate prediction as to the bubble's peak. Now, let me read that again for emphasis. There is little discernible pattern. I would say no discernible pattern that allows accurate prediction as to the bubble's peak. We can talk all we want. We can have all the models we want. We can have all the fancy math we want. Over the past 400 to 500 years, we have not been able to figure this out. The smartest people alive have not been able to figure it out. You won't either. Do not try to time the market. The Mann Group goes on to hit a couple of other things about Bitcoin specifically, because that's why they wrote this article. And is the S&P 500 in bubble territory? And they, in 2018, said no. Had you gotten out of the market in 2018, think about the run-up you would have missed between 2018 and 2026. Today, when I'm recording this, kind of June of 2026. This is the same advice we would give investors, is the same advice you need to absorb as a product developer. If you're thinking about AI in terms of your product development, whether you're doing software, robotics, or really any type of physical product development, food, agricultural product, the real question isn't, is AI in a bubble or not? Should you be getting in or not? The real question is, how do you use this technology that's clearly here to stay to enhance and help you better deliver your product to real customer needs that you see right now? Whenever you're tempted to think about, like, hey, where in the hype cycle are we? Don't think about relative dates. Don't follow the Gartner Hype Cycle. Actually, go take a look at data. One of my favorite tools is Google Trends. Actually look at the real data for how that trend is unfolding, and that will give you a much better idea of how to time your product development. And that dog out there agrees with me. Until the next time, I'll see you on the next one.